I'm so excited to share with you everything about understanding your credit report and score. My name is Tina Ponder. I've been with GreenPath. We are a nonprofit financial wellness organization since 2010, and I have presented this to so many different groups of people. So whether you feel like, hey, I've got this, I know my credit score, I know I'm doing a great job, this is a perfect place to be. It's also a great place to be if you do work in the financial industry. It's always helpful for me to kind of go through this a few times a year so that I can just kind of get refreshed on the information. And this information is just so practical, it's so pragmatic, and this is one of my favorite ones. So I'm so glad that y'all decided to join us today. Today, we're going to talk about a lot. So, we've got a lot to cover, and it really is about understanding your credit report and score. We're going to first start out by talking about why credit is so important, and then we'll take a look at credit reports. So, usually we'll kind of take a look at what's on them, how do you get yours? And then we'll talk about credit scores and how they're calculated. A lot of people will call GreenPath and ask us, Tina, how do I build credit? So we'll tell you a little bit about how to build credit. And then we'll talk about a couple of the common credit myths before wrapping up with some tips on how to use credit cards wisely. So before we get started on the ins and outs of credit reports and scores, it's really important to kind of take a step back and consider why credit is so important in the first place. So for everybody that's on with us today, I am going to throw it over to you. Hopefully, you've had some coffee and some lunch. What are some examples of things that you have needed credit for previously? Or what might some examples of things that you have been held back from by not having sufficient credit? And you're not alone if you've been in this situation. I know I have. So we're looking for examples of what you might have needed credit for previously, and then maybe some examples of how credit may have held you back.
I know for me, when I bought our house, I definitely needed a few lines of credit.
Everybody's saying auto loan. That was like the first time that I ever really needed credit. I had student loans, but then once it came to my poor college car dying, I needed a car. And that was the first kind of go that I had with credit. And then, yeah, the home loan for sure. That's a big one. Any kind of big ticket items, I would say it's kind of a lot of times our first introduction to why it is so important. Great answers. So, why is credit important? It says on the screen here, landing your dream job. So, I've worked at GreenPath since 2010. I did financial coaching and counseling one-on-one for about 7 years. And it's amazing how many people were calling us because their employer sent them over to us. So, having good credit may help you land your dream job. So, I think the statistic is that 38% of employers right now do credit checks. So I always tell people it doesn't mean that like having bad credit will prevent you from finding a job. However, it could be potentially used in determining if you'll be offered certain jobs. It is important to note that employers only have access to your credit report. So, whether or not credit is a factor in gaining employment, it really depends on your industry. So, if you work in finance, right? It could be a really big factor. There are a lot of like military jobs or government jobs that require security clearance. So, that's something else to take into account. And a good example of this could be I used to have a lot of clients that they worked for the TSA. So if they wanted a job at the airport, they typically had a credit check done because they do that on all prospective employees. So if somebody were to owe, $7,500 or more in unpaid debt that is in collections, they'll only hire that person if they can show that they have some type of repayment plan to pay the debt back. So it's pretty interesting. That's a pretty important thing there. And I think we mentioned this about housing, right? So renting or owning a home. So your credit history comes into play when you rent or buy a home. So even though renting doesn't actually involve borrowing money like you would need to purchase the home, most rental management companies still want tenants with decent credit as it indicates that you are more likely to pay your rent on time in full as agreed on a monthly basis. If you are purchasing a home, credit does play a huge role in determining if you are eligible for a mortgage. Getting a loan when you need it is I think probably the most important reason why credit is important and why it's my why, right? So having good credit, it could mean the difference in getting a loan when you need it. So anytime you might need to borrow money, your credit is going to play like a huge role, right, in determining the terms of that loan. So one of the questions that we get asked is, what happens if I want to borrow money and I don't have good credit? So I always tell people, if you've seen the advertisements or like they're on the billboards that say bad credit, no problem. Those places can offer loans to us. They typically can approve us for a loan. It really is not the healthiest for us because those are extremely high interest rates. So for example, you might get an auto loan at a 25% interest rate. I think I've seen auto loans at like a 37% interest rate before in Texas. So I typically tell people that could translate to a monthly payment that is double or triple what somebody with good credit might pay. Another reason why credit is important is illustrated in these examples here. So we're going to take a look at two people that are applying for a mortgage. For sake of discussion, let's say that all of the underwriting pieces for Diego and Angela are completely equal. So the amount of income, their stability of income, and Diego and Angela, they may both get approved, which is great. We can, though, take a look at the difference in how credit scores impact the terms of their loan. So we've got Diego, his credit score is a 660, interest rate is a 5.25%, and this is both for a 30-year fixed rate mortgage at $250,000. The monthly payment is $1,381. Diego is going to pay $496,984 for that home that is priced at 250K. Angela has a credit score of 750. The interest rate is lower, right? So 4.63%. The monthly payment is 1,285. Over the 30-year term, Angela is going to pay lower than Diego in the amount of 463,000, give or take, right? So I tell people, why, it might not seem to us like a huge difference. Spread out over 30 years on a loan, a difference in credit score can translate into tens of thousands of dollars. So this could be, hey, I could have bought a car with this, right? In this example, having a higher credit score saved Angela almost $35,000. So for everybody here, if you want to chime in, what advice might you give Diego if he were your friend or your family member before he decides whether or not to move forward with the purchase of this home? What might you tell him? Yeah, Brandon chimed in, go to GreenPath for help for sure. So GreenPath, we do nonprofit one-on-one financial coaching and counseling. So we can kind of go through unbiased the situation with somebody and kind of explain to them what their healthiest options might be. And we really try to help people achieve their goals, right? We want to get you what you need, but we want to help you get there in the healthiest way possible. It's free and confidential to talk to GreenPath. And we've been in business since the 60s, so you're in good hands. I love what Dennis said. Dennis said, build your credit score first and then buy. I think something that is really prevalent in our culture is like instant gratification. And even in like modern times now with our phones, like we're just so used to getting things so quickly. Really waiting could pay off in the long run, right? And then I like what Kathy says too, do a short-term loan or build credit card payments to build credit. So there are so many healthy ways, and nonprofit financial institutions like a credit union are awesome with some of those credit builder products. All right, so let's turn our attention to credit reports. You all did a fantastic job answering those questions. We are going to talk about exactly what's on a credit report and a credit report contains some of the most important pieces of information that creditors look at when they determine what kind of terms they're willing to extend to us. So I always tell people, as borrowers, typically credit is really there to see how risky are we as consumers? How likely are we to pay back in full and on time? That's the name of the game. So there are three major credit bureaus that collect your information and generate credit reports: TransUnion, Experian, and Equifax. When it comes time to apply for credit, different financial institutions, they might review different credit bureaus' reports. So in some cases, if you are applying for a mortgage, the lender might review all three credit bureaus. That's very typical, especially if it is a big ticket item. They might take a look at all of the information, right, on TransUnion, Experian, and Equifax. This is part of why it's important to be on top of what is reporting with all three credit bureaus. And it's recommended that you review your credit report from all three bureaus at the very least once a year. Different information may also report to the different credit bureaus. So in many cases, the information could vary slightly because creditors generally have to pay to report this information. So some creditors may only report to one bureau versus all three, and they may report at different times too. So what is on your credit report with each of these three credit bureaus? There's a lot of I think myths with this too. So this is just kind of a good refresher for us to know what's on the credit report. So the first thing that your credit report contains is your identifying information. So that's going to be your name, your social security number, your birth date, your address, and your employer. This is used so that whoever is accessing your credit can match your information and say, okay, that's Tina, right? She works at GreenPath. This is her information. This personal information, just so that everybody knows, it's not used when calculating your credit score. It really is just to verify our identities. The second thing that, of course, shows up is all of our credit information. So our credit accounts, that could be credit cards that we have, personal loans, auto loans, mortgages, motorcycle loans, right? Student loans, and other types of debt. Your credit report will contain information about when you opened the account, if your payments have been made on time or not, and your remaining balances and your maximum credit limits. So payments will show up as late if you are 30 days or more past due. So if you pay a credit card bill on the 31st day, generally that's going to show as past due or slow paying as late. Other household bills like your rent or utilities generally don't show up on the credit report. There are, though, so many options right now that especially property management companies are offering. And there's also some other resources that you can look into to get your phone bill or your rent showing up on your credit report to prove that, I can pay money every single month in full and on time based on an agreement. If you were to stop paying your things like your rent or your utilities, generally those can be referred to a collections agency and show up as kind of negative information, right? So once in collections, the collector can report the debt, at which point those outstanding debts would appear on your credit report. There is a Fair Credit Reporting Act, and debts can generally appear on your credit report for 7 years, and in few cases longer than that. If you have any questions about that, I am going to pop that link into the resources so that you have those. All right. So the next thing that we are going to take a look at together are your public records. So this can include anything that might be a bankruptcy, tax liens, what else, judgments, and generally any type of public record information can stay on a credit report for 7 to 10 years. That is also like a misconception that people have. So I always let people know that typically it's kind of a long time that those stay on there. So it is really important to keep up with your finances as best as you can for credit. Here is the link for how long debt can stay on your credit report. And then I will also send out some more information to Brandon for the follow-up. Anytime somebody accesses your credit report, that is called an inquiry. So inquiries are another kind of big part of a credit report. And there are two types of inquiries. And there's a hard inquiry. That's any time your credit report is reviewed for the purpose of extending credit. That can be applying for a loan or, hey, I'm going to open up this credit card during the holidays at a store. A soft inquiry includes checking credit on your own. So checking credit on your own generally is not going to impact your score because you're just checking it for informational purposes only. So for example, if I'm going to go to annualcreditreport.com or if I'm going to use an app like Credit Karma, typically checking my own score, that's not going to hurt my score. What is going to impact my score generally is going to be if I'm soliciting for money, if I'm asking a lender, hey, give me some money, right? That is going to be considered a hard inquiry because they're really reviewing to see, am I going to be risky or am I going to be like where am I going to be, right? When they approve me for a loan or not approve me. So a soft inquiry when you check it on your own or if a current or potential creditor wants to make you a promotional offer, like if you get those offers in the mail for credit or insurances, those are soft inquiries. Both hard and soft inquiries, you'll see that they'll appear on your credit report, but only hard inquiries impact the score. And I think I have a question here. What if a creditor checks your credit on their own to increase the credit limit? Is that a hard inquiry? Typically, that is going to be a soft inquiry because we're not asking for money. They are just checking to give a promotional offer. And that could potentially be considered a promotional offer. And if the credit union has any other information on how they might handle that, I'll let them jump in too. I didn't know if Brandon, if you wanted to add anything or Charlotte. All right, I think I have that covered, right? Charlotte?
Yes, I think you do have it covered.
Okay, perfect. So, what is not on your credit report? Your credit report doesn't contain information about your income, your assets, or your savings. I think that is also a myth that a lot of people think that, oh, well, my employer's on my credit report, so my income's got to show up. Our income, anything that we have in savings, any kind of like homes that we own, anything like that will not show up on our credit. It is possible that somebody could have an excellent credit score but they might not have any savings. It's also possible that I used to work out of New York City. I had so many people that were so wealthy, but their credit just wasn't there. So lenders will often look at all of the pieces of your financial wellness picture. They'll look at your income, your assets, your savings, your credit when they make lending decisions because they really want to see how financially healthy are we. And I always tell people a credit score is not a financial health score. So credit is not the full picture. What is on your credit report? So positive credit activity stays on your credit report indefinitely, which is awesome. So if I pay off a car or for example, I paid off my student loans, that is going to stay on my credit report indefinitely. There is no requirement in the Fair Credit Reporting Act for credit reporting agencies to remove positive information like on-time credit card payments. They can remain on your credit reports forever, especially if the account remains open and active. Even after a positive account has been closed or paid off, it typically can remain on your credit report for as long as 10 years. So having more good information can help strengthen your credit history and increase your credit score. It can also help you look more attractive to lenders because it shows that you really have a strong history of positive credit behavior. So obtaining your credit report, I explained earlier that there might be a website that you can go to get your credit report. I'm going to give that to you in just a moment here, but it's really important that information on your credit report is accurate. So something to pay attention to is going to be what does your credit look like and are there any errors? According to a study conducted by the Federal Trade Commission, I think it's 1 in 5 people. So 1 in 5 people have an error on either TransUnion, Experian, or Equifax on at least one of their credit reports. So we are going to talk about how you can get a copy of your credit report. And we recommend at GreenPath that you review that report at least once a year to make sure that everything is accurate and to ensure that you're aware of everything that's being reported. So you do have the option of getting all 3 credit reports at the same time. If you've never seen your reports, this could be a really good idea. Another option too could be, this is what I do is as I kind of go on a rolling basis where like I might look at my Experian at the beginning of the year, and then in the springtime I might look at my TransUnion, and then in the fall and winter I'll look at my Equifax. So that is really helpful too, so that you can kind of see just moving forward throughout the year what's being reported, and it can alert you to any fraud or identity theft faster as well. So the recommended place that we say to get your credit report is annualcreditreport.com. I typically say that Credit Karma is like one of the popular like apps that are out there. It's okay. It's great for credit monitoring. We always tell people to be careful of any of the offers that are there. Annualcreditreport.com is going to be your friend. So it is the website that was set up as a result of the Fair Credit Reporting Act that states that you are entitled to receive a free copy of your credit report from each of the 3 bureaus once a year. We have seen recently that, especially with a lot of the data breaches and things that have been happening, they've really been rolling that where like you can get it once a week for free. So just check on that website and it'll tell you kind of like what the time is to get it. So it'll say you can get these once a year for free, or right now we're running something where everybody has the opportunity to monitor their credit through annualcreditreport.com weekly. So it can be extended indefinitely, and that means that you can get that weekly. When you do go to annualcreditreport.com, I want to make sure that you see like this little logo with the blue and the red and what it looks like here. It's going to be in the upper left-hand corner of the screen, and it's really best to type in the full and exact website address for this one into your browser. There are a lot of imposter sites out there, unfortunately. So I always tell people make sure that you are on the actual website to mitigate any kind of risk for yourself. Look for that logo to indicate that you're in the right place. And then just a heads up before you kind of log in there and get your reports, they do ask you several security questions. So there may be trick questions in there. So I think for me, like it was like, oh, did you open up a mortgage in May of 2008? And what was the lender? And I'm like, I've never had a mortgage before. I've only rented. So if you've never had or taken out a mortgage, the answer might be NA. So keep in mind that those security questions that they list on there, they're really meant to ensure that we are who we say we are and to protect our identities. There's also a form that you can use if you're like, I don't want to do this online. I want to get it mailed to me. And that form can be found at annualcreditreport.com. There's also the phone number, which is 877-322-8228, and they'll actually mail you one out. If you anticipate the need to borrow money, we do suggest to review your credit reports at least 6 months before you need to borrow money. So if there are any errors you have, on there, you've got that time to correct them before you apply. Credit reports are free. This is really important to note that the scores generally are like $7.95 for each credit bureau. So they typically do charge for obtaining the score through there. I really just use it for the information on the credit report. I generally will go to my financial institution, like my credit union, for help in knowing my score and kind of leaning on the apps that they have available. There is a law that requires a lender to provide the credit score they use if they make an adverse decision to your application for credit. So that means if you were denied for a loan or credit card, or you're getting approved at an interest rate higher than the best rate being offered, typically that lender is required to provide you what your credit score is at that time. We don't recommend applying for something knowing that you'll be denied just to get your free credit score. So, right, I would say go to the annualcreditreport.com website, lean on your financial institution so that you can really see what that looks like to protect yourself and not hurt your score with a hard inquiry. If you do find any inaccurate information on your credit report, you have the right to file a dispute First, you'll want to dispute the item with the creditor or collection agency that reported it to the credit bureaus inaccurately. If that doesn't resolve the issue, you can file a dispute with the credit bureaus that are reporting the inaccurate information. You should include any documents to support your dispute and allow 30 to 45 days for that credit bureau to complete the investigation. If you are still unsatisfied with the outcome of your dispute, you can always file a complaint with the CFPB, which is the Consumer Financial Protection Bureau. I've actually filed a complaint with them before. They're really awesome. They're quick to answer and kind of get that open for you to help you out a little bit more. So I'll make sure that I include that within the follow-up information. And then somebody asked, why is the credit score received from annualcreditreport.com different than what the potential creditor sees? So generally these sites are going to use different kind of scoring models. So I generally recommend to use the Fair Isaac Corporation, the MyFICO, the FICO score. And Brandon and Charlotte, you might be able to answer that a little bit better, but typically it's just that there are Vantage scores, right? So the scoring models are based a little bit differently. The true credit score that you'll want to go with is the one that your financial institution uses generally, or your FICO score. And then I did pop that consumerfinance.gov information in here for that complaint if you do have a dispute and you need any help with it and it's not getting resolved. There's also a phone number here that you can call to get that resolved. If you find indication that your identity may have been stolen, I always say it's really important to take action as soon as possible. You'll want to contact all 3 credit bureaus to place a freeze on your credit. This prevents anyone who has your information from continuing to open accounts as you. You can typically do this by calling the credit bureau or going online to their websites. It's important to note that this credit freeze prevents anyone from applying for credit with your information, including you. So if you do ever plan to put a freeze on your credit, you want to contact those credit bureaus to temporarily lift the freeze. So if you're like, hey, I had a freeze on this for identity purposes, I wanted to protect myself, and I'm applying for a car loan in the next 3 months, you'll generally need to contact the credit bureaus to lift that temporary freeze that you put on that. And it's also recommended that you file an identity theft report with the Federal Trade Commission at identitytheft.gov, and that report will walk you through any additional steps that you should take. I'm going to pop that into the chat, and then I'm going to grab some of these questions. All right, so Jen, is there something wrong with the credit score Credit Karma gives us? I mean, this thing about Credit Karma is that typically I like to tell people that it's a great tool to use for credit monitoring. So if you're not going to annualcreditreport.com and you kind of like the format of the app style, it'll tell you like on one of your credit reports, hey, a new collection bill hit. Hey, it looks like you opened up a new account. Is this right? It's kind of an easy way to do that. I generally say with the score that they put on there, it's never accurate. So typically that score, the scoring model that Credit Karma uses is not what your lenders are using. It's not what your financial institution is using. And is it a good idea to lock your credit? So a credit freeze is generally a really good idea if there was just that thing that came out recently that said there was that alert that said that some of the social security numbers could have been breached and that data breach. So typically I tell people if your name, you see that your information is in there, it might be a good idea to put the credit freeze on there because then nobody else can apply. And then once you're ready to get whether it be a credit card or a car loan or a home loan, then you can contact the credit bureaus and lift the freeze. So it's a little bit more of a time investment. Typically, though, it could be really helpful in protecting you. I've had other clients who they know that they have people that are living in their home that might be using their credit, and they've had to lock their credit for that. They've had to freeze their credit for those purposes. It's a good question. So let's get into how credit scores are calculated, because a lot of you have had questions about like what are the scoring models, like is Credit Karma real? So I'm going to kind of talk to you through this a little bit. So making sure that you understand what's on your credit report and making sure that the information that's reporting is accurate, it's important because all of these things that we've been talking about go into your score. So a credit score, we're going to have a 3-digit number that uses the information on your credit report to quantify the likelihood of repayment by reviewing how you managed previous accounts. It's really meant to reflect, and I think I've mentioned this before, how risky it might be for a creditor to extend new credit to you. So typically your credit scores are going to range anywhere between 300 to 850, although it's possible to have a 0. So I think my 20-year-old brother, he's got a 0, right? Because he's never had credit at all. The lower the credit score, the higher the risk an individual will appear to a creditor, because I've got to be able to show that I can faithfully repay my debt. So that FICO score, which is the Fair Isaac Corporation scoring model, is the most widely used scoring model. Another model that you might see, like for example, on Credit Karma, I think they generally use like a Vantage score, and that is going to be used by sites like Credit Karma that offer free credit scores. Because there are different credit scoring models, your score may vary depending on where you're going to get it. So this doesn't necessarily mean, like I think somebody asked, is it wrong? It just means that different scoring models look at slightly different things. So the 5 key factors, and the one that I think is typically going to be a good indicator of what it looks like, is going to be that Fair Isaac Corporation score, that FICO score, which is again the most commonly used scoring model by creditors and lenders. The largest factor that we have control over as consumers is going to be our payment history. So making every payment on time every month is one of the very best things that we can do for our score. So just pay your bills in full and on time, and we've got 35% of our score checked off. The second largest factor is going to be the amounts owed, which includes your credit utilization. So creditors, they want to see that your loan balances are specifically looks at revolving credit card accounts, where your balance could go up 1 month and down the next. Credit utilization looks at how much of your credit limit you're using. So the more credit limit you're using, the more risky that you might appear to be. If you have multiple credit cards, you're going to want to add up those balances and divide the total number of your maximum limits. That's going to be your utilization rate. So ideally, we tell clients that we typically don't want to see people more than 30% of their limits at any time. Not only for credit purposes, also financial health purposes, it could put you in a risky spot. And it's very ideal if you're able to pay off your balances in full monthly. The length of your credit history is 15%, and that's something else that we can talk about too. And that is really how long have your accounts been open? And this could be the age of your oldest account, the age of your newest account, and then divide that up. There's your average. The longer your credit history, the better. So I've had clients call me and they'll say, well, hey, I've paid off everything. I I don't know why this looks the way it is, right? And it's like, how old is your credit? Let's take a look. And maybe they've only had a credit card for 2 years, right? So we want to make sure that we're able to show longevity wise that we can pay in full and on time. The new credit is up next, and that's 10%, and that's where our inquiries come in. So we talked about those hard inquiries earlier where we're asking for money, we're asking a lender to lend us money. If you start applying for credit frequently, that can be a red flag to creditors because they start to wonder what is going on that this consumer suddenly needs new credit cards every month and then a new loan the next month. And now this consumer is asking for another credit card again, right? That could make us look risky as borrowers. And finally, credit mix is the last factor that's also 10% that could impact the credit score. Creditors like to see that we have a history of managing different types of credit at the same time. So for example, if somebody's looking to get mortgage ready, we typically at GreenPath recommend having a nice mix of credit that you're paying in full and on time every month. So that could be like one credit card, a car payment, and a student loan. This is one of the smallest factors impacting your score. It can help though to have like that well-rounded type of credit and that mixture to show and to demonstrate like, hey, I can pay different types of bills and manage those responsibly in full and on time every month. Although some areas have a larger impact on your credit score, like your payment history and the amounts owed, all 5 of these factors that you see in the pie chart really play an important role in calculating your credit score. So we are going to apply what we have learned about credit scores, and we are going to take a look again at a Diego and Angela example. For our purposes, each of them, they only have one credit card on their report. Diego spends $800 on his card each month. His limit is $1,000. And each month when his bill arrives, he pays the entire balance off. So he avoids the interest charges. Good for him, right? Angela, she's got a $5,000 balance. She also pays in full and on time. She's only making her minimum payments though, and her limit is $10,000. Who do you think? We're going to put our thinking caps on. Who do you think has a better credit score? Does Diego have the better credit score or does Angela? I'm so curious to know. All right, so Kathy, we've got to vote for Diego. I see some other friends typing in. I've got to vote for Angela. All right, so let us see. Who is it? So in this example, if you said Angela, she has the better credit score, which is crazy, right? I always am like, what? How did this happen? So despite being in more debt, and she's probably going to be taking a lot longer to pay down her balance, and she's also probably paying a lot of interest. One thing that's working for her is that utilization, that ratio of her balance to her overall limit. So her utilization percent is 50, whereas Diego has an 80% utilization rate. So that being said, while Angela may have the higher credit score, Diego is actually more financially healthy, right? He's in a better financial position because he's not paying interest, he's paying the entire balance. And next month, if he's like, hey, I'm ready to buy this boat, for example, he can simply charge less on his credit card. And within 30 days, his score could improve. Angela's probably most likely going to struggle to pay down her debt because she's only able to afford the minimum payments and interest rates are quite high right now. So credit scores, I like to tell clients, they're really a piece of our financial situation. It's really important to remember that a credit score doesn't indicate how financially healthy you are overall. It's not a financial health score. All right, I'm going to grab these 2 questions that I have in the chat. I have one that says, how does shopping around for major purchases affect the credit score if 2 to 3 lenders run our credit? Great question. So typically, we have a window of time, which is 30 to 45 business days, where if we are looking for like a boat, a car, a home loan, we have 30 to 45 days to shop around where it's not going to be hard inquiry after hard inquiry. We do have to alert that we are shopping around for that big ticket item. So we would alert the credit bureaus in that case. We've got that window of up to 45 business days, I believe it is. It's 30 to 45 days in total. And then if you have a credit card with no activity and the stores close it without notifying you, does that ding your score really bad? So that's also a really great question, and it depends. If that is the only credit card that you have, like let's say, I think like Macy's is notorious at the holiday season time to give out credit cards. So typically, if that were the only one that you had on your credit report and you had nothing else, you had no collection bills, no other mortgage payments, car payments, no student loans, no other credit cards, generally closing that out will typically impact your score because you're going to be shortening your credit history. Now, if you have a mortgage and a car payment and you pay those in full and on time and they've been open for a while, typically having one credit card close out, it's not going to be a significant impact to your score negatively in the long run. It's a good question. So it really depends on what your credit looks like at that time and what the other mixtures are when we think back to that pie chart that we had earlier, right? When we think back to this. Okay, so let us talk about how to build credit if you have either never built credit before or you're trying to rebuild after a setback because life happens. As we focus on building credit, the first thing that we'll want to keep in mind are what are our financial goals. So we want to know, what do I want to accomplish? When do I want to accomplish this? And then that'll help me determine what steps I'm going to take moving forward. After I look at everything, I'm going to figure out, do I need to build credit? And am I in a stable financial position to build credit? So you want to ask yourself, do I have a spending plan or a written budget? Do I have consistent income? Is my income currently enough to cover my basic expenses? So am I running short every month, or do I have a little bit of a cushion? If you open a credit card or add a loan payment while you're struggling financially, we say that this could potentially end up negatively impacting your credit score because we generally want everybody to have at least a few $100s in savings to cover a minor emergency. So like a car repair, something medical that might pop up where I've got to pay out of pocket a little bit ahead of time, right? So we always tell people, really think about, where are you financially, and are you in a good position where you do have a little bit of a rainy day fund to where you could start rebuilding credit and really focusing on credit? One of the most common ways to build credit is, of course, by opening up a credit card. Using a credit card for a budgeted expense and paying the balance off in full every month is a really great way to start building a strong credit history. I typically recommend that people pay for a utility bill, like a phone bill every month or a tank of gas every month, and then just pay the credit card off, because really what we want to communicate to the credit bureaus and to the lenders is that I can borrow money and I can pay it back every month. The next thing is a secured credit card. So somebody had brought up earlier, I think, a credit builder product. A secured credit card is a great option because they typically recommend that you make a deposit up front. So they might require that, and the deposit becomes your limit on the credit card. If you deposit $300, you generally will be given a credit card with a limit of $300. It's just like a regular credit card. You'll use that every single month. You get a bill each month with a statement balance and your minimum payment due, and you want to pay it. You would still pay interest if you don't pay the balance in full, even though it is secured by that $300. If you make a late payment, you will still be assessed a late fee, and this could still negatively impact your credit score. A security deposit is only touched. So that $300 for your $300 credit card, secured credit card, is only touched if your account goes into default and is not repaid. Other than making a security deposit up front, the key is treating a secured credit card the same as an unsecured credit card. So you keep your balance low, you make your payment on time every month to build positive credit history, and there you go. A secured credit card is often used to help people with no or low credit build because it is less risky to issue that secured credit card because you're giving a security deposit. As your credit score improves over time, you will eventually receive your deposit back from the creditor. Something to be mindful of is that a prepaid debit card is not the same because they do not report any information to the credit bureaus. A secured loan, similar to the secured credit card, is also a good way to build credit. With this type of loan, a deposit is used to make payments on the loan. So the advantage here is that you can usually set up payments automatically. You'll want to talk over the options to building credit with your financial institution to ensure that you are using the right product based on your goals. You also have the choice when it comes to building credit. So I tell people you've got two options when it comes to using someone else's credit to build your own. The first is to get a cosigner for loans or a joint owner for credit cards. Very, very important to know that both parties, if you do a cosigner or a joint owner, both parties are legally and equally liable for the debt on a joint account. If you plan to go this route, there is risk involved that is important to weigh and have a clear agreement in place with the other individual. Another option is being added on as an authorized user to a credit card. So authorized users are not considered account owners, so you're not liable for the debt. We do want to keep in mind as authorized users that any activity on the account will be reflected on our credit, good or bad. So if you are considering somebody to add you on as an authorized user, you want to make sure it's somebody I can trust. You want to make sure that they make their payments in full and on time, they're managing their finances responsibly, and we hope that they're keeping their balances low to ensure that it helps you build credit and doesn't end up harming you. We're also going to talk about the credit myths. So we've hit a little bit on some earlier, but we're going to kind of spell some of these out for us here. And the first credit myth is something we hear a lot. So closing a credit card will hurt my credit score. So somebody asked this question earlier, right? They said, if you have a credit card with no activity and the store closes it without notifying you, does it ding your score really bad? So this is more like a half myth because it all depends on the person's situation. We've got a couple of examples to back it up for us. In Sarah's case, she has 3 maxed out credit cards. She's using 100% of her available credit. Her utilization portion of her score is really suffering. She's paid off her first credit card. She's available to get a credit increase so her credit score improves. Then she decides to close it so she's not tempted to use it again. Once she closes out her card, her available credit on that card completely disappears. So she's left with a utilization of 100% again, and her scores go back down. So the other 2 cards are maxed out, right? So she's close to her limit. In Sarah's case, closing her card has really hurt her score. If we look at Katie on the right, on her side, she's got 5 open accounts. Her starting utilization ratio is great since she's been using a really little credit. Closing one of her cards will have very little effect on her utilization ratio. So her credit score will not be affected as significantly as Sarah's, though she might still see an impact. It's a really good reminder that credit scores are not an indicator of our financial health. Sarah closed that card to remove the temptation of charging on to it and getting more interest and racking her balance up. So yes, her credit score might have been impacted negatively, but I think she made a great decision financially for herself. With the bigger picture to be able to be more financially healthy, maybe this opens the door for her creating a bigger emergency savings. This is really important too, just to keep in mind. Your goals are such an important part of figuring out where you want to go with credit. If Sarah's goal is to get the debt paid off and she isn't planning on needing to apply for new credit anytime soon, her goals can help her make different decisions than if her top priority is to improve her credit score as soon as possible to get into like a home loan or a mortgage loan. All right, I have a question for everybody here. How many of you have heard to not check your credit because it will hurt your score? Has anybody ever told you this? Just say yes into the chat or no. I've got some people texting me yes through the chat. All right. So if you have been told that checking your own report is considered a ding to your score. No, that is a myth. It is considered a soft inquiry and has no impact on your score. So check your own report or score as often as you'd like. It will not change your score. It's good to check, right? Annualcreditreport.com. The myth is derived from the fact that applying for credit too can hurt our score. We kind of went over all of that earlier. So when you apply for credit, it's considered a hard inquiry, which is different from the soft inquiry when you check the credit on your own. Since credit cards are one of the most common methods that people use to access credit, we are going to wrap up our time together just with some quick tips on how to use credit cards wisely. So the first thing is having money in savings. I cannot stress this enough. Having money in savings as a backup so you can handle an unexpected expense without getting into debt or using your credit card is a great place to start. People would always ask me when I was counseling, Tina, what's a good number for me to shoot for? I always tell people save what you can every month. Even if it's $25 a month or $5 a paycheck, just get into the habit of saving. It'll help you to feel less stressed. It'll help you to get more psychological safety. Typically, the goal would be to try to have a minimum of $500 to cover a $500 emergency, something small. Consider only making one charge a month and making this charge an automatic bill. So I mentioned an internet bill, a cell phone bill, a gas tank, a tank of gas. The reason that we suggest setting up only one automatic charge is that you really only need to generate activity to build your credit score, and it doesn't matter how big or small that purchase might be. So the smaller the balance, the lower your utilization will be. And as we learned, this accounts for 30% of your credit score. So committing to using that card for only a small automatic expense that you'd pay for anyways, and you leave your credit card at home, you can put it in the freezer if you want, that can help you avoid temptation to overspend. The lower the utilization, the better. So a general rule of thumb is to use less than 1/3 of your available credit. For small limits, this means only charging a very small amount. So it is important to both know your limit and that 30% number. If you are paying off a credit card account in full, know that this does improve your credit score, but it might not, right? So paying on time is really what matters. Paying off the balance in full, it can help you avoid paying the additional interest charges. If we think back to that Diego and Angela example, right? Um, it will also help you to live within your means without increasing your debt. So if you can, be a deadbeat consumer, which means you don't pay any interest and you pay off your full balance every month on your credit card. That's better. And finally, be sure to check your credit report regularly, and you want to make sure that that information is accurate. So if you would like to take a closer look at your specific credit situation, Brandon mentioned this in the beginning of the presentation. You can connect with GreenPath, right? You are welcome and encouraged to call GreenPath Financial Wellness for a free and confidential financial assessment. We are officially partnered up with Neighborhood Credit Union, and GreenPath certified counselors can review a soft pull of your credit report with you and talk about steps to build or improve your credit score based on your unique credit history. Something else that we can take a look at, which I think is helpful, is a spending plan in your budget. So we can take a look at like income, expenses. We can help you create some of those goals. It's sometimes helpful to talk it out with somebody else, and we can collaborate with you so that together we can kind of create an action plan with you. We can also talk about other financial options that are related to your goals. So we can talk about housing, debt, and student loans. If you are wondering how might I connect with GreenPath, I think somebody said, I want to share some of this information with my kids. We are able to counsel people 18 years of age and older. If they are 16 and up, they can have a parent on the phone with them. And you can speak to a financial wellness expert at 877-337-3399. Thank you so much. And I will be quiet now because if anybody has questions or comments, or if neighborhood wants to offer anything up, it is now your turn.
So we want to take a few minutes. If anyone has any questions, we'd love to be able to answer those for you. We are going to be sending this recording to your email, so you'll make sure to get a copy of this, as well as any of the links that Tina has given us as well. So we'll give a few minutes here to answer any questions if there's any, and if not, then we will wrap up shortly. right, it doesn't look like there are any questions. Oh, maybe. Nope, okay. So I will stop the recording.